Welcome to the Money Business Podcast. I'm Neal Regino.
Hi, Brian Weyman.
Today, we're going to talk about leveraging collateral, whatever you want to call
Collateral.
it. Basically, taking out money to make money. So, a lot of times, there's first the conversation about when is debt bad debt? Should I be paying more on a mortgage or on a business loan? Credit cards, all that. So, for me, I'd say when it's less than 5% in general, it's not bad debt to have. And that's everybody's situation is different, so don't take this as blanket
Right.
advice. But let's just pretend for a mortgage, for example, if you owe $1,500 a month and you decide I'm going to pay $2,500 a month, and the interest rate's 3.25%. It's obviously higher right now, but if you got the loan a few years back, does it make more sense to pay off that debt or to invest that $1,000 a month at something that potentially can get you more than 3.25%? And does it appreciate the asset faster by paying off the loan? Does the asset grow faster than that interest rate? There's a whole lot of things to think about there. But what we wanted to talk about is how to use leveraging in a number of ways, both on the insurance side and on the investment side. Do you want to start off the conversation on how premium finance works, or do you want me to dive into it?
Well, I can start the conversation, but to your point, and again, it's not blanket advice, but if it were my money, and let's say it were a mortgage and I had 3%, well, I actually do have 3% interest rate on my mortgage, but which is why my house isn't paid off. I'm not going to pay my house off when I don't owe that much. I have 3% when I'm making better money everywhere else. But to your point, there's other ways to leverage money. So premium finance, what's premium finance for those people that have never heard of premium finance? Premium finance is basically, for lack of a better term, it's bank-funded life insurance, I guess is a way you could say it, where what you're doing is you're buying a life insurance policy on yourself that has a cash value. You're building up a cash value inside of it. But what the premium finance piece comes in is you're not paying the whole premium. You're essentially borrowing money from the bank who is paying a portion of that premium. And in return, you're earning interest on the cash value that you're building, and the bank is getting paid back down the road with interest they're charging you from that cash value that you're earning interest on. And the whole game is that you're earning more interest inside of the cash value of your policy than the bank's charging you. Therefore, as the process goes on, you're not paying a full premium for what's typically a very large life insurance policy. And 10, 15, 20, 30 years down the road, whatever the plan may be, you have a boatload of cash sitting in there that you've earned interest on the bank's money and covered your premium. So that's that's premium finance basics.
The way I explain it is it's like buying a house.
I usually have a pen and paper when I do it.
Yeah.
And some graphs and charts.
So I say it's like buying a house. If you had $250,000 in cash, you could buy a house for $250,000 and not have a mortgage on it. Or you could leverage it up and buy $1 million house and have a $750,000 loan. On insurance, it's similar. So first of all, banks have an enormous amount of money in life insurance because for them, it's safe for their balance sheets to have insurance inside of there. So they actually think this is a safe bet in general. But the concept of premium finance has been around for a long time and used to be reserved for the ultra high net worth. So, somebody, maybe they wanted a policy that cost $1 million a year and they put a small amount out of pocket, take out a loan for the remaining amount, and whatever the bank's charging, then the thought is over time that the interest earnings, whether it's an index or whether it's whole life, will end up earning more inside the policy than what the bank's charging them on the loan. There's a lot of ways to set this up. So the first of all, I will say there's a few companies out there now that have lowered the barriers to entry. that the qualifications to get in it, you do not need to be an accredited investor. You don't need to be ultra high net worth. Some of them, the minimum threshold is the household has to make $100,000. They're designed much safer. Uh, the risk involved is there could be collateral calls, which we don't need to
Right.
really get into the details. But if the interest outpaces the cash value in the policy, then other money would have to be brought out of pocket. And there are people who write these with 100% collateral and nothing out of pocket. So a policy could potentially cost somebody $0. It's a really good way to accumulate assets and to get that protection without having to put as much out of pocket when it makes sense for the right person. The other thing, so that's one way to use leveraging in order to accumulate an asset. The other thing is that I wanted to talk about today was actually leveraging your cash value and your insurance. So if somebody, let's say you're a real estate investor or you want to expand your business or franchise or buy another building, and you have enough cash value in your life insurance, you can borrow against it.
Right.
And the benefit to that is a few things. It's not a taxable distribution. You get the money right away. You doesn't go against your credit. You don't have to get any financial underwriting. So it's you borrowing your money, and because it's collateralized by the cash that's in the policy, the rate's typically lower than the going rate, especially on a commercial loan. It's going to typically be lower. Index Universal Life typically has a variable rate, depending on the company, usually average out to 4 or 5%. Whole Life has a fixed rate, usually a little bit higher than the Index Universal Life that's issued in the same year. And then you have to determine who has more potential for gains. But when you use a participating loan, what happens is, let's just say, even numbers, you have $100,000 in cash. You can borrow against the policy. Let's say you borrowed 90%, $90,000 out of that 100. And let's just, for fake numbers, let's just pretend it's a 5% interest, but you have a policy that's earning 6-7%.
Right.
The account still accumulates like there's $100,000 in that policy.
Yep.
So it's known as a participating loan. So potentially, you can have a variable payback schedule. You make the payments when you want to, outside of the normal premiums. So it gives you a lot more flexibility than if you went to the bank, got underwritten, took out a loan for fairly high interest rates right now, relatively high, I should say. We're not at an incredibly high interest rate market, but we are compared to the last 20 years, 25 years or so. So it can be another asset that you can use to potentially leverage to create more wealth.
So the basic way to explain it is that you have this money that you've saved, and rather than spending the money that you've saved, you're borrowing against it as a loan, a leveraged loan, and your money's still earning interest while you've actually used, it's not really your money because you borrowed your money, right? You borrowed against your money. You're paying the lower interest on the loan, and you're earning more in your actual money, whereas if you pulled your money out, you didn't earn anything.
Correct.
That's the basic way to look at it.
Yeah, so the thought is that over time you'd have some kind of arbitrage between the interest on the loan and the earnings in the account.
There's actually, not verbatim for every company, but historical show that typically that arbitrage is always about 1.9%, so called 2%. So you're typically always going to earn 2% more than you're actually borrowing.
Yep. So let's talk about that on an investment account. So not everybody knows this. A lot of people do when I talk to them about this, but something that there's different terms, but let's call it a collateralized managed account.
Mm-hmm.
So if you have a 100% stock portfolio and you have collateralization on it, then typically, depending on the bank that's allowing you to leverage, you can borrow up to 50% of the account value. So $1 million in a non-qualified, non-retirement brokerage account, you can borrow $500,000 because it's collateralized by the asset. The rate's variable, but it's typically lower. It might be somewhere between 3 and 5%, or whatever the going rate is at that time. And you can borrow less when it's an equity account because it's more variable. So you still have potential to make money. Your money's still in the market, but you borrowed against it. Again, you're getting that money out. No financial underwriting. You're borrowing against this, using that as collateral, and you get the money right away. Now, if you use a bond account, the safer it gets, the higher the leverage in general that you can take out. So one thought with a lot of clients is, well, maybe municipal bond's the right portfolio. And say $1 million in a municipal bond. Let's say that the portfolio managers were able to get you a 4% yield, and depending on where they're at, they're 100% tax free, right? So you're keeping that full 4%. And you can borrow up to 80% of the account value. And again, depending on the bank, but typically 80% of that account value. So you're able to leverage $800,000. It's variable rate, but let's say the rate's at 4 to 5% on 800,000, but you're making 4% tax free on the $1 million.
You're not really paying 8%.
Yeah, then you're actually
4%.
Then you're actually allowing an arbitrage there, just because there's more money making the 4% versus the money that you're paying the loan on. So there's options for that as well. So that comes into consideration a lot of times when people are thinking about making big purchases, whether or not this makes sense for them. You do have to stomach, again, there could be collateral calls with that as well. So there's a little bit more risk. With life insurance, it's a little bit more stable, a little bit safer than the other options that I just mentioned. So it's worth considering. But I know plenty of people that have built additions to their businesses, bought property that leveraged in different investments, either from insurance or from managed accounts, that they were able to collateralize in order to utilize that. So it's something that we deal with pretty frequently, and it's something that a lot of people that have a lot of money realize that they can use their money to make more money. And
the moral of the story is, if you have savings, don't automatically go directly to your bank for a loan. Look at your options. If you have enough of a nest egg, you can leverage against it and save yourself a lot on interest.
Yeah. So just thought it's worth touching on that, because clients do ask us that a lot. How am I going to pay for this, and how does this cash value and this insurance or this one account, how am I going to use this? I just want to buy a boat or whatever it is. And
it's one of my favorite subjects.
Yeah.
Anything to save interest to me and cut down interest, cut down taxes, it's all my favorite subject. Yeah. All that stuff.
So if you want to know more, it's worth talking to an expert about it. And I think that's good enough information as a broad overview of how leveraging works and collateral works, and how people are using that
at the very least. Now people know it's out there.
Yep.
So
appreciate your time.
All right. Thanks for coming. Hope it helps.